Investing in South America. Managing political risk. South America is a true emerging market for investors. This is a place where stocks are cheap and profit seems easy. It's also a place where fortunes are lost and made, more often than not lost. And it is a geography that appears to me the most attractive in the world right now from an investing point of view. And quite a few news have put the region back in the spotlight recently. The messy power transition during the election of the new Brazilian president, the election of turbo-libertarian Milei in the eternal basket case of Argentina, the rise of strongman Nayib Bukele as the Salvador president and his successful crackdown on gangs, the threat of a Guyana invasion by Venezuela, and massive strike in Panama leading to the closure of First Quantum Copper's megamine. And that's just for the largest, most discussed event. Colombia, Peru and other countries in the region provide plenty of political turmoil as well. So how can investors navigate this troubled water, and are the cheap valuations just siren songs waiting to kill the naive investor? Before going further, let's give a quick look at the region. The area is home to 434 million people and has a GDP of $3.6 trillion. For comparison, the EU has almost the same amount of people, 448 million people, with a GDP of $17.8 trillion. This puts South America firmly in the emerging market category, also a relatively rich segment of it, with $8,340 per capita of GDP. Lower than China's, but almost 4 times larger than India's. And I need to emphasize this. The time to see South America as a place of favelas and narco warlords are mostly over. Not fully, but mostly. Not all of those issues are fully resolved, but investors will need to see it as a place with a growing middle class, rising level of literacy and education, and overall becoming safer. The South American population is actually not that young, but also have a rather balanced age pyramid. So this is an area that have achieved demographic transition, avoiding overpopulation issue of India and Africa, but far from a demographic collapse either. So avoiding the quickly aging issue of the developing world and East Asia. By far the juggernaut of the continent is Brazil, with almost half of the continent population, 217 million people, and the next large country are Colombia, 47 million people, Argentina, 44, Peru, 31, Venezuela, 31, and Chile, 17. And literally every top 20 large population center of the continent is located in one of those 6 countries. The region is speaking either Portuguese for Brazil or Spanish for everybody else, allowing for rather homogeneous business operations for multinational and quite easy cultural exchanges. The common inheritance of Spanish colonialism also creates a relative cultural homogeneity. However, the geographic barrier of the Amazon jungle and the Andes mountain have created a pattern of regional isolation and a population density mostly hugging the coastlines. Economics of South America. So first, the raw material. The export of energy, mostly oil, foodstuff, timber and metal are the core export of the region. When it comes to farming, Chile, Argentina, Brazil and Colombia are in the top 5 exporters of almost everything. Coffee, cocoa, tobacco, sugar, maize, soy, rice, fruit, pork, beef, chicken, natural rubber, palm oil and so on. The mining segment is equally impressive, with massive amount of iron, bauxite for aluminum, nickel, manganese and niobium for Brazil, with Brazil niobium reserve being 98% of the world reserve, and copper, gold, silver, zinc, molybdenum, lead, tin, antimony in the Andes, and major deposit of lithium in Chile, Argentina and Bolivia in the lithium triangle. So it is no exaggeration to say that resources from South America are feeding and building the world. And regarding industry, contrary to the image of just a raw material provider, South America is also a strong industrial power. 29% of Brazil GDP comes from industrial production, which is a really high number. The region is mostly self-sufficient in most goods like car, appliances, textile, as well as chemicals, steel, cement, etc. The reason why this is not well known is that these industries are poorly connected to the world chain supply. They produce for the region but export very little. And high-tech industry like semiconductor, biotech and so on are notably lagging or even almost entirely absent. Managing to develop local expertise and global champion of high-tech industry will be a key to the region's chance to escape the middle income trap, a term that was created to describe South America's relative economic stagnation after years of growth. And regarding services, the service sector is definitely underdeveloped due to historically poor infrastructure. The spreading of high-speed internet is changing that, with several impressive fintech companies emerging from the region like Mercado Libre. Geopolitics. Overall, a great asset of South America as a region is its distance from the great powers' struggles. While the continent has been roughly under the tutelage of the USA, with the Monroe Doctrine for the last 2 centuries, it is not a battleground for influence. This might change in the long term, but realistically not for at least another decade or more. Russia is barely present here, and China is a main trading partner, but seems uninterested in interfering as long as raw resources keep flowing. And would China want to interfere? It really could not do much beside a game of economic carrot and sticks, lacking entirely expeditionary capability or a blue water fleet. With the border of Eurasia burning or at risk of exploding in Ukraine, Israel, Yemen or Taiwan, this alone should put South America on investors' radars. Politics. The resource wealth, dynamic demography and solid industrial base should make South America very attractive to global investors. The issue is local politics, with the countries in the region famous for shooting themselves in the foot on any given occasion. South America is notorious for its regular surge of left-wing populism, nationalization and Marxist insurgency, only to be interrupted by right-wing dictatures and repression. It can be blamed partially on the inheritance of colonial institutions, poor rule of law, or slavery. The result is a perennially unstable political situation, with the pendulum constantly oscillating widely between far left and far right. This caused the eternal objection to any investment idea located in South America. It is cheap, but the expropriation risk is too high if this guy becomes president. The alternative version include the politician will just steal all the money in the company, or corruption is too high, and so on. Which are fair points. Countries with a history of corruption tend to stay corrupt. So how to manage political risk? So, managing the political risk. This brings me to the point of this video. A very common idea is that investing in a South American country is just too dangerous if the president is left-wing. I actually think this is the exact opposite, and that an established left-wing government is the ideal moment to invest in South America. So let me explain. The perfect example is given to me by Argentina recently. By far the most dysfunctional political system in the continent, except maybe Venezuela, and that's quite saying something. Argentina has gone from being richer on a per capita basis than Western Europe at the turn of the century, to a country plagued by regular hyperinflation, mass unemployment, and so on. As a result, the common investing wisdom have emerged: never, ever, ever invest in Argentina. The winds might be changing, with the election of Javier Milei, a rather unorthodox politician who got elected on the premise of dismantling 90% of the Argentinian government, dollarizing the economy, and so on. And nothing say moderate reform like wielding a chainsaw at political rallies. Most Argentinian stock jumped 20% in his election, with the national oil company YPF doing an astonishing 40% up in one day. And since its low of 2022, YPF stock is up fourfold. My own personal exposure to Argentina, the farmland and real estate company Cresud, ticker CRECI, grew less from Milei election, but has grown quite well from the 2020s bottom as well. The important part is that this gain could only be captured by buying these stocks when the stranglehold of leftism over Argentina was at its strongest. Back then, no one wanted to discuss Argentina. Even Brazil, a much less dysfunctional political system, was beyond the pale for most investors. And now that Milei is elected, I had several people asking me what I think about it. So, as usual, prices drive the narrative. Pricing in risks. How is it that when borderline lunatic monetary and economic policies were looming over Argentina, that was the best time to invest? It is for the same reason that are the basic of the old investing adage, often attributed to the founder of the Rothschild dynasty. Buy when there's blood in the streets, and even if it's your own. In the years before the Milei election, Argentina was heading for another hyperinflation, mass immigration, default on its international debt, government collapse, and so on. This is what blood in the street looked like, and in that case it was sadly at times quite literal. The naysayer will always forecast a Venezuela-like scenario of total collapse and expropriation, with a total loss of all investments. But the only actual question is to figure out if the risk is already priced in the current valuation of the country's companies. Calculating risks. In practice, you need to run it as a simple risk calculation. Is the risk of full communism this year is higher than the current expected yield plus the chance of repricing? In the case of Argentina, when it was really bad situation, the expected yearly return could be estimated at anywhere between 20 to 100% depending on how you calculated it and your assumptions. So you would have need a more than 30 to 50% chance of Argentina turning into Venezuela that year for the risk to not be priced in. Even the most pessimistic or right-wing oriented commentators were not forecasting that. And the potential for profit, even if the situation just go from terrible to simply bad. And we need to analyze the situation rationally. Another great example have been Petrobras, the Brazilian national oil company, in the last 2 years. The stock price has fluctuated more accordingly to Brazilian political situation than oil prices or profits. The stock first rose when Bolsonaro looked like he would be elected. It then crashed again when it was a socialist Lula who won the presidential election, and riots by Bolsonaro supporters did not help either the optic of the country. And since then, Petrobras stock's price have very slowly clawed its way back up, as the forecasted apocalyptic takeover by Lula turned out to be pretty boring, if anything. But really, was it that surprising that Lula would be somewhat not relevant to Petrobras stock price? During his last presidency from 2003 to 2011, Petrobras stock rose from $5 per share to $40 per share, with even a spike at $70 per share. So, if historical data are to be trusted, Lula's presidency should have been forecasted as pretty good for Petrobras stocks. Once again, price drives the narrative. The most repeated narrative, even to this day, is that Petrobras stock crashed due to the company being looted by Lula. And for sure, there was some corruption and some shady deal that might have siphoned some money out of the company. But in reality, it had a lot more to do with oil and oil stocks entering a decade-long bear market, after the fear of peak oil production in 2008 proved unfounded. And then the shale oil revolution in the US added to it. So, after all, from 2011 to 2020, a safe jurisdiction oil stock like Shell went from $77 per share to only $25 per share. A pretty terrible loss for a safe stock. Trading sentiment. The maximum gain can be targeted when the political situation is dire. South America politics are a pendulum, and the more left they swing, the more right they will swing back. Case in point with Argentina and its chainsaw swinging president. The associated theorem is that the minimum gain is when the political situation is rosy. The more economic growth, the better the currency, the stronger the commodity market, and the more South American masses will want free stuff. Free education, free healthcare, free family benefit, discounted fuel, discounted food, travel, etc. And the more all of those free things will be paid by actually looting large companies, raising tax, and debasing the currency. Funnily enough, the stronger the economy, the higher the valuation multiple still. So let's look back at some risky stocks that were trading at a price-earning ratio of maybe 1 to 3 during the socialist period. With the pendulum swinging right-wing, a good capitalist time will see this stock maybe not only close to its peak cyclical earning for the decade, but also trading at multiples and price-earning ratio of 10 to 20. So from there, the earning shrinking or multiple contraction can completely hammer such a stock. If both occur at the same time, losses of 70 to 90% might be on the menu. And this is this kind of losses that give South America a bad reputation. So in my opinion, the more positive the overall sentiment, the less you should invest in South America. And the more negative, the more you should. Sentiment review. So in order to give some clue of what country seems to have the most potential in the region for investor, I will rank roughly the sentiment for each major country. And remember, the more negative the sentiment, probably the better for your future investing return it is. The most abysmal sentiment is definitely for Venezuela. Nothing to say much here. The country is with the most oil reserve on earth is also unable to feed its people. It's just sad. And it will maybe become one day the best target for investors as soon as the country gets liberated from its dictator. On the very poor sentiment, we have Suriname. The country is not on anyone's radar besides some oil analysts. And it might, however, be the new Guyana. And its neighbor Brazil and France are unlikely to invade. So Suriname, with a lot of oil reserve potential, could be a replacement for Guyana. And Colombia, the ultra-leftist president trying to shut down the country's main export of oil, plus the stigma of a sticky narco-traffic image of the country is keeping the sentiment really negative. On the poor sentiment category, we have Brazil, mostly due to the Lula presidency. It was very poor right after the election, but has not much happened and not much turmoil since the election occurred. It has improved since, as illustrated by Petrobras stock price rising from around $10.6 per share to around $16 per share at the time of recording of this video. And then in the neutral category you will find Argentina, thanks to Milei presidency. And it's a bit of a mixed bag, Argentina. It's a mix of still very negative sentiment, Argentina never changed, never invest in Argentina, and very positive sentiment, with people seeing Milei as a savior of the country. Depending on his upcoming success or failure, one of those opinions will be vindicated. Peru also had some recent protests against copper mine and general unrest that somewhat damaged its image as a premium mining jurisdiction, but still not an overly negative image. And Guyana. Guyana used to be a positive image thanks to tremendous amount of oil, but with Venezuela threatening to invade the defenseless nation, these have somewhat degraded. And that absurd amount of oil per inhabitant, higher than Saudi or Qatar, might still make Guyana a good long-term prospect, and more importantly a non-cyclical growth prospect, as long as it managed to not get invaded and therefore get somewhat protected by either the US or Brazil from its aggressive Venezuelan neighbor. And in South America, maybe the country with the most positive image is by far Chile. It is the richest country in the region, and to my opinion have a lot of risk, with several rewriting of the Pinochet-era constitution having been rejected by both left and right wing of the political spectrum. This might surprise negatively with increasingly polarized and dysfunctional politics, and being the richest country of the region, have more space to fall. Coming next, In the next iteration of this ongoing Investing in South America series, I will successively look at the different countries and sectors, looking to give a general overview on the continent's opportunity and potentially cheap stocks. This will include energy, tech, including fintech, farming, and mining. If you like this content, please subscribe to the channel and consider subscribing to my Substack newsletter, link in the video description. I publish a free article approximately once per week and a premium report once per month. Until next time, stay safe, stay informed.